In a difficult context over the past several years, the global economy has shown remarkable resilience. Global growth is set to continue, even if at a more modest pace compared to historical standards, with global GDP growing by 3.1% last year. And looking ahead, there are now several reasons for some continued optimism for the months and quarters ahead. Yes, the impact of tight monetary conditions continues to be felt, particularly in housing and credit markets. However, global activity is proving relatively resilient. Private sector confidence is improving, inflation has declined within sight of central bank targets, and risks to the outlook are becoming more evenly balanced. Indeed, as you can see, inflation has declined significantly from recent peaks. In advanced economies, inflation decreased from 9.9% at the end of 2022 to 3% in the first quarter of this year. This decline in inflation has come about as a result of the combined effect of restrictive monetary policy, lower energy and food prices, and a continued easing of supply chain pressures. The OECD unemployment rate in February remained at 4.9%, close to its lowest levels since 2001. Total employment across all 38 OECD countries was 3% higher in December 23 than it was 4 years earlier in December 2019, that is just before the COVID-19 pandemic hit. And at 3.5% up, jobs growth was particularly strong for women over this 4-year period, compared with 2% for men. Our employment outlook, to be launched in early July, will provide further in-depth analysis of the latest developments we see in our labour markets. High nominal wage growth and declining inflation are now helping real wages and real household incomes recover in many OECD countries. A real income growth last year was positive and stronger than in 2022 in the large majority of OECD countries with available data, which means that workers and households are benefiting more from economic growth again. Trade growth is also recovering gradually. Global trade rose in the fourth quarter of last year as a result of strong growth in China, Korea, and the United States. Recent high-frequency indicators on merchandise trade and export orders suggest that the recovery of trade is continuing into this year. We expect steady global growth in this economic outlook for 2024 and 2025. Global GDP is projected to grow at a rate of 3.1% again this year, the same as last year, but up from the 2.9% we projected in our interim economic outlook in February. For next year, we project growth to edge up slightly to 3.2%, also slightly above the 3% we projected in our interim outlook. Overall, though, we expect global growth for 24 and 25 to remain below its long-run average. Emerging Asia, that is China, India, Indonesia, and dynamic Asian economies, continues to account for more than half of all global growth. For the United States, we project growth of 2.6% this year and a lower 1.8% next year, due to higher borrowing costs having a moderating impact on demand. Growth in Japan is expected to increase from 0.5% this year to 1.1% next year as a result of stronger real wages growth, continued accommodative monetary policy, and temporary tax relief. Across the euro area, which stagnated in the fourth quarter of last year, increasing real incomes, tight labour markets, and decreasing interest rates are projected to lift growth from 0.7% this year to 1.5% next year. Inflation in the OECD is also projected to continue its decline to 5% in 24 and 3.4% in 25. By the end of 25, inflation is expected to be back on central bank targets in most major economies. While risks to the outlook are becoming better balanced, the uncertainty, though, remains. Attacks on shipping in the Red Sea have led to a rerouting of trade flows. Compared to the last quarter of 2023, just a few months ago, we estimate that cargo traffic through the Suez Canal has shrunk by 51%, while trade around the Cape of Good Hope has increased by 60% over that same period. A widening or escalation of the evolving conflicts in the Middle East could lead to renewed price pressures, supply shortages, and a consequent decline in global growth. Corporate and household debt has risen significantly over the past 15 years in several emerging market economies. And as our global debt report released 2 months ago shows, half of all corporate bonds in emerging market economies will come due over the next 3 years and will have to be refinanced at higher rates. Currency depreciations or capital outflows could push up costs of borrowing for firms and households. Risks are particularly acute in countries where private sector debt is denominated in foreign currency. On the upside, demand could prove stronger than expected if households and firms were to draw more fully on the savings they accumulated during the COVID-19 pandemic.
So the recovery continues to unfold differently across different countries. And despite tighter monetary conditions, global activity is proving resilient and employment remains high. I'm going to start with inflation. So we have been through an inflation shock of a generation. This has been incredibly painful for people, not least as the biggest price increases have been for essential items, for food and for energy. In particular, those on the lowest incomes have been squeezed by these sharp price rises. So where are we now? As you can see here on the left-hand side, in 2023, headline inflation fell rapidly in the US and in the euro area. And this decline has continued this year, though less quickly and less smoothly. Inflation is also moderating in Japan. Restrictive monetary policy has played a role in bringing inflation down. Lower energy and lower food prices have also helped. On the right-hand side, you can see core inflation. This excludes the most volatile components such as energy and food. And this also has declined, but more slowly than headline inflation. What has been remarkable is that so far inflation has fallen without a corresponding rise in unemployment. This chart shows you just how unusual this is. The blue diamond shows the current unemployment rate across OECD countries. And this is at or close to the lowest level unemployment has been in the last 20 years, which is shown in the grey bar. This is better than we or others expected, and it is important and it is very welcome. It means people have been better able to cope with the difficulties of higher prices and of higher interest rates. We are now seeing demand and supply of labour becoming more balanced, with lower levels of vacancies and fewer firms reporting recruitment difficulties. Now let's take a look at some country-specific developments. So we'll start with Japan, who are the chair of this year's Ministerial Council meeting. After 3 decades of low inflation, which you can see on the left, prices are now rising, and this is a welcome change. On the right-hand side, we can see the policy rate has turned positive, and alongside this, yield curve control has ended. Looking ahead, growth in Japan is projected to recover steadily after the first quarter of 2024, with domestic demand underpinned by strong wage growth, more accommodative monetary policy, and temporary tax cuts. As a result, we expect moderate growth of 0.5% this year before strengthening to 1.1% next year. Let's move to China, which is facing some deep-rooted economic challenges. On the left, we see real estate investments. These have been in a prolonged downturn since 2021. Fast growth in earlier years has generated excess capacity, particularly in smaller cities. The ongoing adjustments in the real estate sector will likely persist for several years, and this will weigh on residential investment and on private consumption. On the right-hand side, we can see foreign direct investment in China, which has been negative for the last 18 months as foreign investors withdraw from the country. This reduces the prospects for higher growth in the short and in the medium term. Growth will be supported by fiscal stimulus this year and next, including on infrastructure investment, as well as strengthening external demand. Nevertheless, we project growth to fall to 4.9% this year and 4.5% next year as it returns to its gradually slowing trend. Elsewhere in Asia, we're seeing robust growth. Let's have a look at two examples. So last year, GDP was buoyant in India, helped by strong public investment. In Indonesia, we saw strong domestic demand. We project that both economies will continue to enjoy rapid growth through 2024 and 2025.